Welcome to another episode of Regtalks. In the next few minutes, we'll walk through 6 international tax developments. UK updates to Pillar 2 jurisdiction lists, Sweden's first-year GIR filing relief, Portugal's clarification of GIR filing procedures, Australia's adoption of the OECD Common Understanding, Panama's new economic substance rules, and Malaysia's revised guidance on foreign tax credits. Let's get into it. We start with the United Kingdom. On June 2nd, 2026, the UK updated its list of recognised jurisdictions and taxes under the Pillar 2 framework. The update concerns qualifying income inclusion rules, qualified domestic minimum top-up taxes, and QDNTT safe harbour recognition. For multinational groups, these lists are not just reference materials. They affect how groups assess top-up tax exposure, whether a foreign domestic minimum tax can be treated as qualified, and whether safe harbour treatment may be available. The broader point is that Pillar 2 compliance now depends on live administrative lists, not only legislation. Groups need to monitor whether jurisdictions, taxes, and safe harbours are recognised in each filing location, because a change in recognition can affect both reporting and tax outcomes. Next, Sweden. The Swedish tax agency has updated its guidance on global minimum tax obligations to reflect the OECD's Common Understanding on first-year GLOBE information return filings. The update is aimed at easing practical issues in the first filing cycle. In particular, Sweden's approach allows relief where a GIR is centrally filed and certain information exchange arrangements are still being finalised. This follows the broader OECD position that jurisdictions should use available domestic mechanisms to reduce duplicate filing pressure and avoid unnecessary penalties during the initial implementation phase. For in-scope groups, the practical question is whether the central filing jurisdiction is accepted, whether the local notification is made on time, and whether the GIR can be exchanged between tax authorities. Sweden's update shows how national tax authorities are now translating OECD coordination into operational compliance rules. Now to Portugal. The Portuguese Tax and Customs Authority has issued guidance on relief from local GIR filing obligations under the global minimum tax regime. The guidance explains how Portuguese entities can rely on the OECD agreed approach where the GIR is filed centrally by an ultimate parent entity or designated filing entity. A key administrative point is the Model 62 registration declaration, where a declaration has already been submitted but names a central filing jurisdiction that is not included in the OECD annex. The declaration must be replaced. For calendar year 2024 fiscal years, the relevant deadline is 30 June 2026. That makes this a very practical compliance update. Groups need to check not only who is filing the GIR, but whether the registration declaration correctly identifies a jurisdiction that qualifies for relief. Next, Australia. The Australian Taxation Office has updated its guidance on global and domestic minimum tax obligations to incorporate the OECD Common Understanding released on the 18th of May 2026. The update is part of Australia's implementation of Pillar 2, where multinational groups may need to lodge information and meet payment obligations under both global and domestic minimum tax rules. The ATO's guidance is especially important because Australia has already been preparing groups and advisors for the first lodgement cycle. The key message is similar to Europe, but from an Asia-Pacific perspective. The first Pillar 2 filing season is now about systems, accounts, loans, notifications, and return mechanics. For groups with Australian entities, the ATO guidance should be reviewed alongside the group's central GIR filing position. Now to Panama. Panama has enacted Law Number 526 of May 28, 2026, introducing economic substance requirements for multinational enterprise groups earning foreign source passive income. The new rules apply from the 2027 fiscal year and cover categories such as dividends, interest, royalties, capital gains, real estate-related income, and other movable capital income. To retain tax-exempt treatment under Panama's territorial system, affected entities will need to demonstrate real substance in Panama, including personnel, premises, local decision-making, and operating expenditure. If the requirements are not met, foreign passive income may become subject to a 15% tax on net taxable income. The law also introduces stronger anti-abuse rules, updated permanent establishment provisions, and annual reporting obligations. This is a significant transparency and anti-avoidance development for multinational structures using Panama. Finally, Malaysia. The Inland Revenue Board of Malaysia has issued Public Ruling Number 3/2026, providing revised guidance on bilateral and unilateral foreign tax credits. The ruling is relevant where a Malaysian tax resident is taxed both in Malaysia and in another jurisdiction on the same income. It explains how foreign tax credit relief may apply, including the distinction between treaty-based bilateral relief and unilateral relief available under domestic law. For multinational groups and cross-border taxpayers, the practical issue is documentation and calculation. Foreign tax credit claims require evidence of foreign tax paid, correct identification of the income concerned, and careful application of limits. Malaysia's update is therefore less about a new tax and more about the mechanics of avoiding double taxation while staying within the rules. Thanks for watching Regtalks. Welcome.